people, we will start with the new topic, that is chapter number 2, buyback of securities and equity shares with differential rights. This particular section has about 2 topics. One is the buyback of equity shares wala topic, and if you have equity shares with differential rights, what to do is another particular section. The second one is a small section, mostly for theory, or you may get about 2 to 3 marker one. Buyback of securities is the important element. Okay, the name itself is saying buyback of securities, and when we're talking about securities here, we're talking about equity shares. Buyback of, what does the word buyback mean in accounts?
Buy back someone's own profit.
By the
Company is buying back its own shares.
Company is buying the share back from the shareholders. Any other thoughts from anybody else? Initially, the company has given the shares to the equity shareholders. Now the same shares the company is buying back from the same shareholders. That only perfectly we call it as buyback of equity shares. Basically, we are cancelling equity shares. If a company issues equity shares, it will show it as equity share capital. So today we are in the mood to cancel that equity share capital. That's all. Are we fine? That's all is this particular topic all about. There are certain companies act a restriction. You can't left, right, center cancel every 100%. There are certain limits. Let's not worry about the limits for the time being. Okay, let's know a little bit of the concepts and then dive into the problems. Then I'll cover few more companies act a provision and we'll take it up further. Are we good? So simply we are cancelling equity share capital. Good. Okay. So 1 minute before we dive into the topic, I'll take you through a small scenario, or maybe if you want some advantages and all of buyback, not much tested in examination, mostly just given in study mat, which I've brought in. Why the companies resort for buyback of equity shares is, 1, to increase the promoter's shareholding. Normally, like, if suppose I hold about 40% and you guys own 60% in a company. In a particular company, I own 40% and all of you own 60%. All of your shares, if I buy back and cancel, what will be my shareholding? Will it still be 40 or it will increase? It will become 100%. Because all of you are not shareholders anymore. Who's the only shareholder now? Me. That means my shareholding from 40% will become 100%. To increase promoters' shareholding, this is one of the ways to do that. Why do you want to increase promoters' holding? To avoid the hostile bid to take over. See, basically, whoever owns majority of the share, they control the company. Yes. Okay, taking the same example, let's say there is a company X Limited where I am holding about 40% and you guys, meaning the others, are holding about 60%. Okay. Let's say somebody came up to all of you and said, you sell your shares back to me for, let's say, 1 crore rupees. They approached all of you individually and told, I'll give you put together how much? 1 crore rupees. Sell your shares back to me. Earlier, I was holding how much? 40%. All of you. Okay, there are many shareholders, let's assume. All of you were holding 1%, 2%, 0.5%, like this, etc., etc. Put together, all of you were holding 60%. That means in this particular company, who was the majority shareholder till now? Me. Because I am the single largest shareholder who's owning about 40%. That means I have a significant say in all the decision. Yes, if I say yes, probably that the matter will move forward. Otherwise, it will stop because I am holding the maximum voting power. Correct? Suppose you sell this shares to another person. All of you sold this share to another guy, Mr. Z, let's say. Okay. That means Z will have how much percentage now? 60%. Now, who's the majority shareholder in this company? Z. Automatically controlled moved from my hand to Z hand. Yes, no? This is what we call it as hostile takeovers. Okay, so if you buy company ka shares, automatically shareholders are the owners of the company, right? More shares you buy, you control the company. So to avoid this, few of the shares held by others, periodically the company will cancel. They'll buy back. So that the promoters ka shareholding will go on increasing. So that the promoters only can still continue controlling this company. This is one of the reasons why they do it. Just theoretically, these are not much important from examination perspective. Did you understand the simple meaning of this? One, to increase promoters holding, and others to avoid takeover of a company. That's all in simple words. Okay. If you do this buyback, EPS will increase. Earnings per share will increase. We will see more of this in accounting standard 20. It will come later. There's an accounting standard 20 which talks about earnings per share. there, whenever you do the buyback, number of shares will reduce. So your earnings per share will increase. How? In AS20 we will see. Suppose now I have enough cash with me. I don't have any expansion plan. I have enough cash with me, surplus cash. I don't want to expand. Okay. I don't have any plans to do anything with that. So initially when I wanted to start this business, shareholders gave the money to me, to the company. Now company is in an expansion mode or they have surplus cash. Surplus cash. Now they can give that cash back to the shareholders and say, I think we are good. Okay, so that's what, when they have surplus cash and when they don't need it for business, they give the cash back to the shareholders and collect the share certificate back from the shareholders and cancel it. That's all. These are some of the objectives or advantage of doing a buyback. Simply know 1 or 2 points. So far not tested. Okay. TCS buyback is happening. Many companies do the buyback. That's not a problem. It periodically happens. Yeah. All right. That depends, sir. You can't just generalize like that. Whether it will increase or decrease. It's very difficult to say. It depends on what price the buyback is happening. Okay, which company is buying? What is their growth prospect? Who are the shareholders? Who's running it? Price you can never determine by a particular factor. Price of a share market is influenced by a lot of things. Now these times, because many people are projecting recession, high inflation, Fed rate increase, RBI rate is increasing. So left, right, center share price is falling. Good company also. They are posting good results. Still the share price is falling. So that depends on a lot of other factors. Yeah. So that let's not worry about the stock market wala funda, why it will increase or decrease. That is altogether a different ballgame. Stock market is like a wild horse. Sometimes it runs backwards. Okay, let's not go into that. Okay, so let's worry about more towards the examination relevant topics.
The shareholders should have to accept it.
Correct, sir. Shareholders have to accept.
If your large amount of shareholders accept it, but few shareholders not accept it, sir.
I said no. There are certain Companies Act provisions. We'll discuss that later. Obviously, all this has to be conducted through a resolutions. You need to have shareholders yes for it. Only then you can go forward. Whether you want a simple majority or a major majority, we'll discuss. All that is Companies Act provision. For now, let's not worry about it. For now, let's go into the relevant accounting concepts. Okay, so the topic is what, sir? Buyback, and we are specifically talking about buyback of equity shares. Sir, if you cancel equity shares, we call it as buyback. If you cancel preference shares, we call it as, or preference shares or debentures if you call. Instead of buyback, we use the term redemption. Buyback or redemption. It's the same name, same meaning with just the different names. Are we okay? That will come in your group 2. Redemption of, or rather group 1. Redemption of debentures and redemption of preference shares is there in your group 1. Buyback of equity shares is there in your group 2 accounts. So it's just a name given. That's the name given. That's all. To redeem something means to pay back. Okay. For this one, they're using the term buyback. That's all. Just the name given. Or somebody coined it and we have got stuck with it. That's all. Okay. It's like calling. Why did they call personal account personal account? They could have called something else. No, I can't. I'll have no say in that. It's just a certain names in. Sorry. Yeah. And I'm not saying. Just saying that somebody would have coined a name and it just gained popularity. All right. That's all it is. Just a different. Maybe they thought, let's differentiate between equity and preference. So they've given 2 different names. That's all. Okay. Sir, when it comes to the methods, there are 3 methods through which you can do a buyback. 3 modes of doing or 3 methods of doing a buyback. For class purpose, we will call them as, no need to copy all this. Just listen to this. If you understand, that is good enough. Or maybe we'll go method by method. All of you participate here with me. This is important. If you have understood this, good chunk of the problem is done for, I would say. Sir, I'm preparing balance sheet in the account format just for simplicity's sake, for the sake of example. Let's say we have equity share capital to the extent of 1 lakh rupees. We have some P&L account. P&L account is coming on the liability side. So it has a debit balance or credit balance. Meaning it has a, let's say P&L is, let's say 5 lakh rupees. So this is P&L is debit or credit? Credit. If it is debit balance means it will be denoted in brackets. We don't show it on the asset side. In liability side only, you show it as a negative number. That's all. So this is a profit only. all these numbers are assumed for sake of simplicity. Let's say there is a bank loan extent of 3 lakh rupees. On the other side, we have assets, various assets, PPE, current assets, blah, blah. We're not much interested into that. Leave that. Now, what is the topic name? Buyback of equity shares. That means you are cancelling equity share capital. Can I say so? We can't cancel 100%. Just for the sake of example, I will take 100%. Only for the sake of convenience. Okay. So, what is our equity share capital? 1 lakh. We are buying back. That means we are cancelling. So, this one from 1 lakh, this will become 0. This cannot be done. There is a ceiling limit. Ignore that company like a provision. Just to understand, I'm going forward with this example. So 1 lakh has become 0. That means, can I say shareholders have got back their money? They had invested about 1 lakh when we don't know, maybe 5 years ago, 10 years ago, whatever. Now they have got their money back because shares have got bought back. So far good. So shareholders are outsiders or owners? Shareholders are the owners of the company. Suppose if a company shuts down. Who should get the money first? Owners or outsiders? Suppose I'm stopping the if I'm ending the company means who should get the money first? Outsiders. In my example, I have two components of liability. One is equity share capital, other one is a bank loan. Can you tell me who's the owner and who's an outsider in this example? Equity shareholders owning equity shares are the owners of the company. Bank loan people are the outsiders. That means ideally, who should be repaid their money first? Shareholders or bank loan people? Bank. Here what happened? Equity shares got cancelled. Meaning equity shareholders got their money back. Did you repay bank loan? No. Is it fair for bank loan people here? Owners are taking their money from the business soon. Outsiders are still left hanging. Yes or no? If tomorrow if something goes wrong with the business, can these bank loan people go to shareholders' house and say, give me your assets, give me your gold, give me your car, give me your building? Like this, can they ask? No, because company has a limited liability. I mean, this puts bank loan or the outsiders in big trouble. Yes or no? To sort out this, there was a concept introduced known as Capital Redemption Reserve. CRR is what we call it. To safeguard the interest of this bank people, a concept was introduced known as Capital Redemption Reserve, CRR. What Companies Act? All this is given in not accounting standards or accounting rules. All these are Companies Act 2013 wala rules, what we are discussing. Okay. What Companies Act says is, did you cancel preferred equity share capital? Yes. How much did you cancel? 1 lakh. Okay. So equity share capital from 1 lakh became 0. So what is the reduction or gap in capital? 1 lakh. To that extent, you need to create CRR. The CRR we create with an intention to protect the outside liability holders. In my example, that is a bank. Did you get 2 pointers over here? Whenever you buy back equity shares, meaning whenever a capital has got reduced, one reserve you need to create. What is the name of that reserve? Capital Redemption Reserve, CRR. Why is it created? The intention is to protect the outsiders. To what extent do we need to create CRR? To the extent to fill the capital gap. How much was capital before? 1 lakh. How much has it become now? 0. So how much has it reduced by? Or how much is the gap in capital? 1 lakh. To fill that gap, we create CRR. First point, is it okay for everyone? Got it? So CRR is created with an intention to protect the bank people. Sir, how does creating one reserve? Next question is, sir, how does bank loan ka people interest get protected by creating a reserve known as CRR? Yes, no. How that happens is, sir, CRR is created from free reserves. CRR is created from free reserve. Free reserve means those reserves from which you can pay dividend. If you look at the Companies Act provision of a free reserve, definition of free reserve, those reserve from which company can give dividend, that is known as what? Free reserve. In my example, can you give dividend out of P&L, sir? Yes. That means, is P&L a free reserve? Yes. Generally, general reserve and P&L, we call it as free reserve. In our problem only we will see these two, or instead of general reserve, these days they'll also call it as revenue reserve. And nothing but general reserves. Is that okay? Basically, any reserve from which you can give dividend is a free reserve. Now you are creating CRR. You want to create CRR here? Yes. How much value? 1 lakh. You can create CRR from what reserve now? You can create it from P&L. After creating CRR, will P&L balance be 5 lakh or it will reduce?
4 lakh.
How much CRR are you creating? 1 lakh. Means from 1 lakh you have to transfer from CRR to, or rather from P&L to CRR. So P&L balance will become how much? If the CRR was not there, what would have been your P&L balance? 5 lakh. How much dividend you could have given to shareholders if CRR was not there? 5 lakh. Because from P&L you can give dividend. No? If the CRR was not there, company would have distributed a dividend of 5 lakh. But now how much is there in P&L? Only 4. Now how much dividend can be paid to the shareholders? That means how much money got blocked in a way? 1. So that's how outsiders' interest gets protected. This is okay. So amount is different, no? Just a random example. Okay, don't worry about the amount tying out. Did you understand how creating a reserve helps your outsiders over here? This is only for your knowledge sake, not required for examination. In your examination, they will ask how much CRR needs to be created and from which reserve. That's all. That's all will get tested as a journal entry. This topic is also very simple. Like internal reconstruction, you need to just prepare some journal entries and one balance sheet. That's all. Okay, here in journal entries will be a lot simpler. Hardly maybe 4 or 5 entries will come. Okay, so this is first method or the first aspect. If you have any doubts, I can take it up or I can move on to the next one. Sir, what if P&L is a debit balance? Sir, it's a loss-making company means, will they think about buying back and all, sir? So if you are doing a buyback means your position should be good. Only if you are a profit-making company and that too a good profit-making company, then only you can do the buyback because shareholders will not give the share just like that as he asked. If the shareholders have to give share, if you want to cancel the shares, no, shareholders have to surrender the share certificate. That time they will say, give me a high price. Market maybe the share price is 100. Shareholders may ask, if you want to cancel, give me 150 or give me 200. So all that is also there. For that, company should be in a good position. Okay, otherwise it will not happen. So loss-making company, it will not happen. What is CRR? Somebody is saying, Gauri, she logged in just now. CRR is capital redemption reserve. Okay. Okay, let's have one quick step through there, whatever we have learned, and then we'll move on to the next one. So buyback simply means cancellation of equity shares. If you cancel equity shares, will there be a gap in capital? See here, 1 lakh of capital became 0. So how much is the gap or a reduction in capital? 1 lakh. So Companies Act provision simply says, if at all there is a reduction in capital, that gap has to get filled up. Meaning that has to get filled up by creating one reserve known as what? Capital reduction reserve. How much ever gap is there in capital, that you need to fill it up. How much gap is there here? 1 lakh. Hence we created how much CRR? And CRR is created with what intention? To protect the interest of the outsider. How does it protect? CRR is created from what reserves? Free reserves. In my example, we have P&L, that is a free reserve. So when you create a CRR, free reserve balance will reduce. CRR balance will increase. If the CRR was not there, means earlier free reserve balance would have been 5 lakh. So you could have given the dividend to the extent of 5. But now you can give a dividend to the shareholders only to the extent of 4. That way the money in a way is getting blocked. So that blocked money helps to protect the interest of the outsiders. That is the intention.
That P&L account money only will receive.
Don't confuse P&L with money, sir. Just because if you have a P&L of 5 lakh does not mean you actually have cash also of 5 lakh. Okay. Here P&L is prepared with a concept of accrual. For money we need a cash system. Okay, just because you have raised a point, maybe I'll take it up. Sir, you purchase the goods. You purchase the goods for 1 lakh. You sold it for 1,50,000. Let's say no other expenses there, no other income. Did you make any profit? You didn't make profit, huh? How much profit did you make? 50,000 rupees. So that means this profit will be shown in P&L account. Are we okay? So far good? Okay. Alright. Now, how much money you have with you? You sold the goods, so how much money is there with you, sir? First, you invested 1 lakh rupees to buy the goods. After that, you have sold the goods. How much did you sell it for? 1,50,000. So how much cash is there with you? Cash balance is 1,50,000. Check if P&L and cash balance same. You could have used this cash to buy one machinery. Let's say I use this cash to buy a machinery of, let's say 1,40,000. Now what is my cash balance? 10,000. But my P&L balance is still 50. So don't confuse P&L with cash balance. It may be same, but generally it is not. Okay, so that is different. If you want to do the buyback, you need to pay the money. The money will be there in your bank balance. If there is no money, people will think about buyback, sir. Because you may do all the CRR, bar, whatever. Shareholders will simply ask, what a vanakam. No. When you will give me the money. Pana, correct. Okay, so that's all. So if they don't have enough bank balance, they'll not even think about doing all this buyback. So far, okay, that will come in the problems. That's not the intention. Here I'm only targeting the CR. Panamda, okay. So one question somebody is asking, sir, okay, I understood CRR is created from what, to what extent we create, what is the logic behind CRR, that and all, I think I've got it. Tell me, once they create CRR, what will they do with this? Group 1 topic. Have you heard about this bonus shares? So CRR, if there is any reserve, no, if the company wants to utilize CRR, it can be used just for one purpose, that is to give bonus shares. No other purpose. Bonus issue is there in your syllabus, group 1, not here. Is that okay? That's the only purpose. Yeah, for right shares you cannot use CRR, only for bonus. You transfer all that, and in case of winding up, if you have the reserves and all, no, where do you show the reserves? Under shareholders funds, no? You transfer it off to equity shareholders and finish it off. Amalgamation topic, I'll tell you all this. Not leave that. That's not required. That's way too ahead. We just started, you want to shut down. That's not nice of you, da? Okay. Alright, did you get the intention of things now? Here? Okay, no. Alright, let me see how well you have understood. I told there are how many methods to buy back? 3. First method is what? Profits. Second method is, I'll call it as, and all this I'm using the pet name only for class. Names are slightly different. Second method is shares. Let's say company, okay, I'll assume the same balance sheet. So how much is the equity share capital we had? 1 lakh. So we had a P&L balance, 5 lakh. Okay, and we had a bank loan of, okay, whatever number, it's okay. 3 lakh. No. Okay. So you want to buy back equity shares, meaning you want to make this to be 0. Let's say for the sake of buyback, company has issued a new preference shares. They've issued new preference shares worth 1 lakh rupees. The company has issued some new preference shares worth how much? 1 lakh. And they want to cancel off equity shares. Okay, let's go again one step back. Equity share capital from 1 lakh has become 0. Is there any gap or reduction in capital? Yes. How much gap is there, sir? 1 lakh. What I told, no matter what, that gap has to get filled. Whenever a redemption happens or buyback happens, you need to create one reserve known as what? CRR. That is capital redemption reserve. To fill what? To fill capital gap. Now you cancelled equity shares, all right. But did you issue any new preference shares? Yes. You issued preference shares worth how much? 1 lakh. Let's say this is 10% preference shares. That means one extra component will come. What is that? 10% preference share capital will come because the company has issued a new shares. Preference share capital will increase by how much? Now tell me how much CRR will you create? 0, 1 lakh, something else altogether. Creative people, can't help. 0, 1 lakh or something of your choice. Something, sir. 0, 0, 0, 1 lakh. No, first answer my questions. Only I go like this policy. Once I ask a question, that's easy way, no? To avoid a question, easy way is what? Ask. For a question, you ask another question. Not way you get it. We'll take your question later. First answer this. 1 lakh, 0 or what? 1 or something else. Something. Huh? You don't answer my question, I'll not answer yours. Okay. Yeah. Perfect. See, I told what, sir. Again, I carefully use my sentence. What did I say? CRR is created to fill capital gap. How much was equity share capital before? How much now it became? Means what is the gap in capital? when you issued preference shares, did that gap not get filled up? Yes. How much preference shares you gave? 1 lakh. Now what is the gap in capital? 0. How much CRR you need to create? 0. This is one they'll ask in examination. Okay. Did you understand everyone now? Okay. Now your question, sir. What is it? Okay. 1 minute. What if redemption is there? 2 lakh. What if redemption is there? What redemption? What redemption are we talking about? Somebody saying 2 lakh. What if preference shares also will get redeemed? Hey, that and all this. What, you want to cancel everything, Ada? No. We're going one step at a time. Okay. So basically, CRR is created to fill the gap in capital. Check how much has the capital got reduced by and fill it up by creating CRR. That's all. Yes, sir.
10% preference shares.
No, you have to partially right. You have to give these preference shareholders a dividend at the rate of 10%. But that depends on what. Okay, let me hear on your question.
They can adopt the dividend
By the
reserves of CRR.
reserves of CRR.
They adopt the dividend.
CRR can be used only for one purpose, sir. That is to give bonus shares. You cannot declare dividend out of CRR because that will beat the whole purpose. No. See, CRR was the intention to protect the interest of the outsiders. From CRR also, if the Companies Act says give dividend, that means what about these guys? Those guys will be completely lost, right? Will be totally unfair. Hence, Companies Act has brought a provision that if you want, this is not accounting, this is company law ka restriction. CRR can be utilized just for one purpose and one and only one. That is to give bonus shares. Meaning, bonus shares means extra shares or extra equity shares given at free of cost. If you want to make this CRR 0, no, you have to give additional equity shares worth 1 lakh. So equity share capital again will increase by 1 lakh. CRR will become 0. That's the only way to increase. Otherwise, it's not possible. No other reason, it's not permitted. You can issue the debentures, not a problem. But what did I say? Again, go one step. His question is, sir, instead of preference shares, I've issued debentures. Okay. There is a thin line of difference because it becomes an interpretation call. Actually, no, the method name is shares and securities. Our CA books includes only shares. Okay, but if you're writing CS, I remember CS used to interpret securities to include debentures also. But our CA ka thought process is, why are you creating CRR? To fill capital gap. Do you show debentures as capital or do you show it as a long-term borrowing? By issuing debentures, can you fill the capital gap? So that's the reason they ignore it. Till now, let me look at it. If they've brought in any modification study material, you can. Because this becomes totally interpretation call. Okay, 2 line. But we'll have to stick to whatever interpretation our CA books are doing. Good question, but I hope I've answered your question. Okay, basically, ignore debenture for CRR purpose. Till the time our institute considers it. If they consider it, I have no other choice but to modify it. Okay, because ultimately CA institute is the king. Because here actual Companies Act uses the term shares and securities. So you could say, you could interpret debentures also as what? A security and include. Okay, but right now it's not being done. Interpretation is only shares. That's the reason we'll ignore it. Okay, anything else? Again, one step ahead. That is my third method. Okay. Anything else? If CRR issued, we will it be sure security for the bank loans? Okay. See, again, if you want to utilize CRR, you have to give additional shares, additional bonus shares. So that means your share capital will increase. And share capital is there. Even bank loan people will be thinking what? Anyway, capital is there. So that means in a way my interest also will get protected. So that way, all these are just theoretical thought process. But ultimately, if the people run like Nirav Modi, Mallya and all, then everybody Tirupati toss. All these are what? To protect the interest of the outsiders theoretically. Practically, how much is very much debatable. Okay, let's not worry about practicality. More importantly, we need what? Right now, we need to clear the examination. Is it possible for ICA to interpret something when the actual law says something else? No, actually, law is not very clear on securities. So that's the reason we'll have to stick to what our material says for the time being. Okay, they've not clearly defined it, at least my knowledge of reading it. Okay, So let's stick to it. Let's not go deep dive into that and say like, create a mess out of it later. Okay. See, knowledge is good, but you should use it wisely. Sometimes overly knowing something and overly showing off few things, can be what? Can land you in trouble. Okay, because you will write all these big, bari words, quoting section number, this case, that case. Invigilator will say, he does not know all that. He is an accounts faculty. You are going on jadifying what? Lock-up provisions there. So stick to what is required. If you don't, that's what they say, if you don't like a rule, get to the top and then change the rule. First you have to get to the top, meaning you have to qualify. First qualify, then we can change about all this. Okay, now? Okay, anything else? What the? Okay, so first method is what? Profits. Second method is what? Shares. Third method is combination, meaning partly profits, partly shares. Okay. Let's say here company utilized preference shares. They've issued new preference shares, but only to the extent of 80,000. Same balance sheet again here. Our equity share capital, how much, sir? 1 lakh. P&L, 5. Bank loan, 3 lakh. Now you tell me this 1 lakh of equity share capital, will it stay as 1 lakh or what it will become? Since you have bought back equity shares, this will become 0. At this point of time, how much has the capital got reduced by? So the gap in capital is 1 lakh. Did you issue any new preference shares for this particular process? Yes, let's say this is again 10% preference shares. That means what will happen? 10% preference share capital will come in. Entire 1 lakh or only 80,000? Its face value is 80, so it will come in for 80. Now, how much CRR will you create? Unanimously 20. Gap was initially how much? 1 lakh. How much of that gap already filled up by giving preference shares? 80. How much gap is still remaining? 20. So to fill that remaining gap, we have to create CRR. So CRR is a simple funda. How much ever gap is there, fill it up. Or you could put it the other way. There are two ways to fill up a gap. One, issue new shares or create CRR. But no matter what, that gap in capital has to get filled up. That's all. That is your third method. Did everyone understand this? Any questions, anyone so far? Okay. If you want it other way, in the first case, did you issue any new shares? That means you utilized entirely what? Or you did buyback of shares entirely by using profits. How much profits did you utilize? 1 lakh. How much CRR did you create? 1 lakh. In the second case, you did redemption or you did buyback by using entirely new preference shares. So how much profits did you utilize in the second case? 0. How much CRR did you create? 0. In the third case, how much preference shares did you utilize? 80. That means how much have you utilized from profits? 20. So how much CRR did you create? Another way to remember CRR. How much ever profits or free reserve you have utilized, to that extent you create CRR. Or create CRR to fill the remaining gap. Two ways to remember, whichever you are comfortable, remember it. That's all. This only most probably combination scenario you can expect in examination. Okay, because that includes both the methods. In study material, all the types of problems are there. We'll keep covering it. You don't have to write a method and all. They'll give you a scenario we need to solve. Basically, our intention here is how much CRR needs to be created. That you need to be aware of. That's all. If you're okay with this, I think we can dive into the problems. That's all. This is the only concept I wanted you to have a clear clarity on. So what about journal entry? You tell me the journal entry, sir. I'll not even discuss. You tell me the journal entry. Perfect. One, you are cancelling equity shares. If you are cancelling equity shares, you are cancelling equity share capital. Equity share capital has a credit balance. How do you cancel it? Debit. So the journal entry will be equity share capital account debit. Share capital is shown at face value. So cancellation also will happen at face value. To what? Whom you have to pay this money to? Equity share holders. Normally on the day of buyback only you will not pay the money. Since you will not write to buy, you can write, some books will write to equity shareholders account, but our material is using separate account known as, or for simplicity we'll keep this. Whom you have to pay this money to? Equity shareholders. That means the journal entry will be equity share capital account debit to equity shareholders. I'll modify, it's not that, there's something else. I'll look at it in the problem. That is when you pay the money, what is the journal entry? equity shareholders account debit to bank. So you're creating CRR no? Okay. In this problem we'll take how much CRR are you creating? 20,000. CRR you can only create from what? Free reserve. What is a free reserve in my example? P&L. Entire 5 lakh are you creating CRR or only 20,000? Only 20,000. That means P&L balance will reduce. CRR balance will increase. P&L is having profit means it will have a credit balance. How do you reduce something that has a credit balance? So the journal entry to create CRR is free reserve account debit to CRR. That free reserve either could be general reserve or P&L. So the journal entry is general reserve / P&L account debit to CRR account. That's all is the entry. Maybe one more entry will come if there is a premium. Ignore that. So entry is very, very straightforward over here. Manageable. The crux of this funda is one is the CRR, another one is how much can you buy back. Can't cancel 100%. There are some provisions that we will probably take it up in tomorrow's session, or if time permits today. Okay, and there are certain restrictions. You can't cancel 100%. Okay, let's do a thing. Let's apply whatever we have learned in things so far. Let's apply it in one of the questions. I think we can start with, let's do question number 1 itself. Okay, just maybe before I dive into first question, always remember there is one provision of Companies Act, I think, which we need to kind of check before we proceed. If you want to buy back any equity shares, they should be fully paid up. When I say fully paid up, it should have reached the face value mark. Let's say face value of the share is 10 rupees. That means the shareholder should have paid 10 rupees. Only fully paid up equity shares can be bought back, meaning only they can be cancelled. Not accounting rule, Companies Act ka provision. All these are. Okay, that's one thing which we need to test in every problem. So I called out that. Okay. So let's dive into the question. M Limited furnishes the following balance sheet as on 31st March 20x1. All the balance sheet value are in thousands. One doubt, sir. In buyback, company is giving money to shareholders, right? Yeah, money is giving. We'll see. One journal entry will solve fully one problem. I think some of your other doubts also could be clarified, if at all you have any. Share capital, we have prepared note number 1. Total share capital is 5,000. Let's come to note number 1. They have given authorized, issued and subscribed capital. All are same. We have 3 lakh equity shares of 10 each. So the face value of the share is 10 and these shares are fully paid. So that means can the company do the buyback? Yes. So 3 lakh into 10 you're going to get 30 lakh. 30 lakh, if you have to express it in 1000, it will become 3,000. All the numbers they are giving it in thousands. That's all. We have a 20,009% preference shares of 100 each. That's about 20 lakh, which they're calling it as 2,000. So total is about 5,000, which they have shown in the main balance sheet. Reserves and surplus, they have prepared note number 2. Total reserve is 6310. Let's look at what and all reserves we have. We have capital reserve. How much? 10. Revenue reserve. Revenue reserve is nothing but your general reserve, which is 4,000. Securities premium we have, which is about 500. P&L account. P&L account debit or credit balance?
Credit balance.
So they're showing it as a positive number. So it means it has a credit balance. If it is a loss, they'll show it in brackets. So then that's when we'll say P&L is a loss, meaning it has a debit balance. So here it is a profit making. It's a P&L is having a credit balance, a profit balance of 1,800. Sir, you can create CRR from what I told? Free reserve. Free reserve means those reserves from which you can pay dividend. Capital reserve is not a free reserve. Security premium is not a free reserve. Meaning from these two you cannot give dividend. From these two, if you are not giving dividend means can you create CRR using capital reserve or securities premium? You can create CRR only by using general reserve or P&L. So which to use? The choice is yours. Okay. Generally, our material uses the general reserve. It's okay. You can, even if you want to use P&L, that's not a problem because there is no kind of priority there. Done. So only these two reserves, revenue reserve and P&L account, is available to create CRR. Okay, then moving on, we have long-term borrowings. Note number 3, 400. At note number 3 is they're saying we have 10% debentures to the extent of 400. Great. Then we have trade payable 40 and the total is there. We have property, plant and equipment. Note number 4, totally 2750. Probably you have various assets. No, they have given only one. PPE ka original cost is 3,000. Provision for depreciation is 250. So what is the carrying amount of that? As of now, the value or the book value of that plant and machinery or that property, plant and equipment is 2750. That 2750 only they have shown it as PP in the balance sheet. Non-current investment is about 5,000. Then we have various current assets like inventory, receivables, cash. Pretty much straightforward. All these are not much relevant for our buyback adjustment. So reserves usually have a credit balance. Yes, reserves does have a credit balance. Okay, so balance sheet over. Let's look at the adjustment. The company has passed a resolution. I told you, if you want to do all this just like that, you can't do. You need to take the permission of the shareholders. Okay. So here they have passed a resolution to buy back 20% of equity share capital. 20% of shares you are buying back at what price? 15 per share. Because if the company wants to buy back, means the shareholder has to give the company share certificate. What is the face value of that equity shares? 10. Are the shareholders ready to buy back at 10 rupees? They are saying, sorry, if you want to do my buyback or if I have to give my share, you have to give me 15 rupees. So is the company giving anything extra for the purpose of buyback here? Face value of the equity shares is 10. But for the buyback or the buyback price is 15. Are they paying any extra? Yes. How much is that extra? On one share, how much extra? 5 rupees. That extra is a loss, right? We call that loss as premium on buyback. Instead of just calling it as a loss, we call it as a premium on buyback. Fair enough? Or you can also call it as premium on buyback of equity shares. Good so far? Okay. For this purpose, it sold its investment of 30 lakhs for 25 lakhs. What is the total investment we had in our balance sheet? We had 5,000. All these numbers are in thousands. That means this is 50 lakhs. Okay. Entire 50 lakh of investment did we sell or only 30 lakh? Investment of 30 lakh, we sold it for 25 lakh. So 30 of investment, if we are selling it for 25, did we make a profit or we end up making a loss? How much loss? For this scenario, you just need to pass a journal entry. First problem, so no balance sheet. Normally in these sort of problems, they'll give you adjustments. Along with that, you also need to prepare the balance sheets. So it's okay. So first problem, fatapat we'll do it. Excuse me. Now the simple journal entries. Journal entries, whose books all this drama is happening? Journal entries in the books of Yamma. Okay. So for buyback, if you want, we can, for journal entries, we can keep a certain pattern. There is no pattern of order of any journal entries. Okay. Just for us to remember the things, to have a smooth flow of things, we will pass journal entries in a particular order. The order will be something like this. First, check, we'll pass the journal entry for all those transactions from where the company has received the money for inflows. Here, has the company received any inflow? Yes, they have sold an investment. First, we'll pass up the entry for that. Other than this, there will be 4 journal entries for buyback. Other than this, one set of journal entry will be for the inflows. In some problem, we will sell investment. Some problem, we may sell some property, plant and equipment. Or we might have issued some new preference shares or debentures. For all that inflows, first we will pass the journal entry. Then I said there will be some 4 buyback entries. Not necessary you have to pass it like that. This is just for the sake of remembrance. In examination, if you have a checklist, it will be easy to check whether have you passed all the entries. Only for that sake. Otherwise, there is no order. You can pass it in any one. So come back to the problem. Is there any inflow happening for the company? I'm not talking about outflow. I'm talking about the inflow. Is there any inflow? Yes. The company has sold some investment. What is the journal entry for the investment sold? Have they given the dates by any chance here? If they give the dates, do bring in the dates as well. No dates are there. So the journal entry is bank account debit. Since they've given all the numbers are in thousands, I will also express it in journal entry. I'll express it in thousands itself. Easy way. Bank account debit. How much did we sell it for? 30 lakhs. Okay. 30 lakh. If I have to express it in 1,000, I sold it for 30 worth of investment. I sold it for 25 lakhs. Okay. That means this will become 2,500. What did I sell, sir? Investment. So the investment I need to cancel by crediting it. What is the book value of the investment that I've sold? 30 lakhs. By expressing in 1000, it will become 3000. That means, did you sell the investment at a loss? How much loss? 500. So this is a loss on sale of investment, which will be transferred off to P&L. So I'll write it as loss on sale account debit. This loss on sale will be transferred off to P&L. Meaning, because of this, our P&L balance will reduce. Since we're not preparing balance sheet, this adjustment may not have too much relevance. So narration being investment sold. Simple narration. You can give more information also, being investment sold at a loss and all that. Our narration and all, keep it as crisp as possible. No need to give full drama. Too much also don't expand, because as such we have a time shortage. So this is one. Did we issue any new preference shares or debentures? We read the problem. Did we encounter anything like that? No. Okay, that means this is over. Now we'll get to the actual buyback entries. What are you buyback or what are you cancelling, sir? You're cancelling equity shares. That means you're cancelling in a way equity share capital. Equity share capital has credit balance. To cancel, we will debit. So the journal entry will be equity share capital account debit. So entire equity shares are we cancelling or just 20%? Just 20%. Check the problem in note number 1. How many equity shares we have? Sir, we have a 3 lakh equity shares. Entire 3 lakh we are cancelling or only 20%? 20%. If you do 3 lakh at 20%, you're going to get 60,000. That is the number of shares. 60,000 equity shares we are cancelling. So share capital is always shown at face value. So to cancel also, we will debit it to the extent of face value. And the face value in this problem is 10 rupees. So that means this will be 6 lakh. 6 lakh, if I have to express in 1000, it will become 600. Okay. All right. But am I paying the shareholders 10 rupees or are they asking extra? Extra. The buyback price is not 10. It is actually 15. They're asking 15. So how much extra? 5. On one share, they're asking an extra 5. So it's a loss. Nominal account rule says the loss is to be debited. That loss we give a fancy name as premium on buyback. Premium on buyback account debit. How many shares are we buying back? 60,000. That is nothing but 3 lakh ka 20%. On one share, how much premium are you giving? 5. So totally premium is 3 lakh. 3 lakh, if I have to express in 1000, it will become 300. Okay. So totally, how much I need to pay to the guys? 900. 9 lakhs, or I'll express it as 900. That we park it in a separate account known as to equity share buyback account, or you can simply call it as share buyback account. To equity share buyback account. Some books will also, instead of equity share buyback, they will directly write to equity share holders. But our study material is using this, so I'll probably stick to this. It's okay. Anyway, dummy account, it will get nullified. Once you make the payment, that account will get closed. So to either you can write to equity share buyback or you can simply write to shares buyback account. That is fine. Narration will be being equity shares bought back. If you want, you can also write further as per resolution number ... dated ... because all this will have some resolutions. But okay, majority of the problem, no. Earlier version of study material used to have the resolution and all. New version, they are not mentioning the resolution. If they are suggesting shortcut, why should we break our head? So we'll simply keep the simplistic one. Okay. So this is the journal entry for cancelling. Sir, this premium is what? It's a loss. Where will you transfer this loss to? P&L. But hang on. If you just check, if you remember in your foundation days or something, section 55 of Companies Act deals with securities premium. Security premium has 5 utilization. One of the utilization is if you have any premium on buyback, like this premium on redemption of premium on buyback of equity shares, or for buyback purpose, you can utilize security premium, they say. So instead of transferring this premium on buyback or transferring this loss to P&L, you can set off that loss with security premium if security premium has a sufficient balance. Check. Do we have, first of all, security premium? Yes, we have. How much balance? 5 lakh or 500. How much is the premium on buyback? 300. So just, do we have enough balance in securities premium? Yes. So that means what is the transfer entry? Instead of doing P&L account debit to premium, you will write this premium you need to cancel now, or you need to transfer. You have debited the premium. How do you transfer it? By crediting. So the transfer will be done through, or it will be transferred off to security premium account. How much is that premium? 300. So security premium account debit to premium on buyback 300. Narration is simply being premium transferred or being premium adjusted with securities premium. Something like that you can write. It's okay. Sir, why will shareholders ask for a premium if we are cancelling the shares? See, this is a negotiation. I have this calculator. You want it. You want to buy it at 100. Does it mean I will sell it to you for 100? I may ask 500 also. Yes, possible. There's a simple transaction happening between two guys. The price could be anything that they agree upon. The price could be lower than face value, or it could be higher. Okay, that's a negotiation. But generally, if you want to buy back, this buyback and all will happen at a premium. Otherwise, shareholders will not surrender their shares. So without they surrendering, you cannot go ahead. First of all, before you go with the buyback, they should say yes to that. Unless you say the price, they probably will not give their yes. So that's the reason. It's a simple negotiation. Okay, sir. Sir, I told whenever you buy back equity shares, your capital there will be a reduction or there will be a gap. Check. You bought back equity shares worth how much? 600 or 6 lakh. Since you cancelled the equity shares, your equity share capital is reduced by 6 lakh. Did you issue any new preference shares? So how much is the gap in capital at this point of time? 6 lakh. Did that gap get filled? There are two ways to fill the gap. One by issuing new shares or by creating CR. We read the problem. Is there any new shares coming in? That means we are following which method? The first method. That is the profits we call it. Okay, so that means what we need to do? We need to fill up the 600 by creating CRR. So what is the journal entry to create CRR? Or from what and all can you create CRR here? Using free reserve. What is a free reserve here? Revenue reserve is a free reserve. P&L is a free reserve. You can utilize any of the two, or you can use both in any combination. Study material generally uses the general reserve. If you want to stay in sync, you can use that. So because of this, what will happen to your revenue reserve? When you create CRR from revenue reserve, your revenue reserve balance will reduce. CRR balance will increase. So what is the journal entry for that? Revenue reserve account debit. How much CRR are you creating? 600. To what? Capital redemption reserve, or popularly for class purpose we'll call it as CR. So why not 900? CRR is created to fill what? Capital gap. Is premium your capital? Capital is always shown at what value? Face value. So if there is any premium on buyback, premium neither creates the gap nor does it fill the gap. So premium can be ignored for CRR purpose. I'm not asking you to ignore for journal entry purpose. I'm asking you to ignore premium for CRR purpose. Did you understand? Because premium neither creates nor fills the capital gap. Capital is always shown at face value. No, that's the reason we only consider the face value element. Somebody is asking, sir, what if security premium didn't have enough balance? Then you transfer this premium off to your P&L. If you have enough balance, set it off with securities premium. Otherwise, transfer it off with or adjust that premium with P&L itself. Over or one more entry. All the drama, okay, but shareholders will ask what? Give me my money. How much you need to pay them? 600 towards face value, 300 towards premium, totally 900 or 9 lakhs. So when you pay, the journal entry is equity shareholders account debit to bank. But am I using equity shareholders account or equity share buyback account? Since I'm using equity share buyback, so when you pay, the journal entry will be perfect. Equity share buyback account debited to bank account 900. if you want narration for the previous one, the narration is being CRR created. Here the narration will be being amount settled or amount paid to equity shareholders. That's all. Problem over. Any problem here? That's your first. Like now onwards, maybe one or two few adjustments will go on increasing. That's all. But the base is pretty much the same. That's the reason I told first journal entry we'll pass it for the inflows. After that, you will get 4 journal entries for buyback. 1 to cancel your capital, 1 to transfer the premium, 1 to create CRR, 1 for the final settlement. Okay. No balance sheet is there here, so I think the problem is done for. Can I move on to the next question? In fact, what are the 3 methods of buyback I told, sir? Profits, shares, combination. Instead of profits, here books will say free receipt. That for our class purpose, we call it as profits. Next is securities premium. Ignore security premium, you can utilize only to transfer what? Premium on buyback. Other one is proceeds from the issue of shares or securities. Combination they have not written, but combination is a method that generally gets tested in examination actually. So they have given securities premium. So can we utilize security premium to create CRR? Security premium is backed by Companies Act 2013. CRR cannot be, or security premium cannot be utilized to create CRR because they have not called out. That's the reason. Companies Act restriction. Okay. Thinking all of us are fine with it. Okay. To question number 3, all of you. D Limited, a non-listed company. They furnishes the balance sheet as on 31st March 20x1. Same balance sheet, same format. Share capital note number 1 and the value is 2,700. Reserves in surplus note number 2, 9,700, or maybe we'll check the note number 1 as well. Authorized, issued and subscribed capital is, we have 2,50,000 equity shares of 10 each and they are all fully paid up. So that means can you buy back these shares? Since they're all fully paid up, so you can go ahead. So the total value is 25 lakhs. I think all the numbers again they're expressing it in thousands. Oh, it's not typed actually, it should be. Where? Oh, here it is. Okay. All the numbers are in thousands. That's the reason they have expressed this in 2,500. We also have a 2,010% preference shares of 100 each. Check this one. Issued 2 months back for the purpose of buyback. Because of buyback only, this preference shares were issued. Okay, let that sink in. Later I'll come back. So that means this value is 2 lakh, which we are expressing in thousands. That is 200. So total is about 2,700. They've given various reserves. Capital reserve. Is capital reserve a free reserve? No. Is security premium a free reserve? No. You can create CRR only from revenue reserve and P&L. Those only in this problem we refer it to as a free reserves. Okay, all other reserve balance they've given. The company has passed a resolution to buy back 20% of its equity share capital at 50 per share. So the face value of one equity share is 10, but the buyback price is 50. So that means are we paying anything extra here? 40 rupees is extra per share. That extra only we call it as premium on buyback. For this particular purpose, it has sold all of its investment for 22 lakhs. Entire investment sold. What is the value of the investment they are showing in balance sheet? All they had given assets data. Asset data is not much relevant here. That's the reason we didn't bother too much reading. Total investments ka book value is 3,000 they're showing. Basically all these numbers are in thousands. So it is 30 lakhs is the book value, but you sold it for 22 lakhs. That means you sold this investment for a loss. 30 lakh worth of investment for 22 lakhs sold means there is a loss of about 8 lakhs. You are required to pass a journal entry and also prepare balance sheet. One, I think as I said, no, every problem we'll prepare balance sheet for 2 or 3 problems to get our understanding on balance sheet much better. Okay, so same funda. This is question number 3, I think. Okay, so journal entries. journal entries in the books of that D Limited. Okay, I think for journal entry also we are having a small pattern. Pattern required an exam or just for our convenience? Only for our convenience. So first set of journal entry we pass for the inflows. Is there any inflows here? Yes. What are the inflows? Investments sold. So what about preference shares issued? So preference shares already issued 2 months back. No, don't pass journal entry for that. That's the reason it is already coming in balance sheet. So journal entry already passed. At this point of time, the only inflow is the sale of investment. So the journal entry is bank account debit, and I think here also we can express all the numbers in thousands. So bank account debits 22 lakh. If I have to express in thousand, it will become 2,200. I sold investment, so I will credit investment, but the value of the investment in my books is 3,000, 30 lakh, which is nothing but 3,000. That means these investments I've sold it at a loss of 8 lakh, which becomes 800 when you express in 1,000. So this is nothing but your loss on sale account debit, which gets transferred off to your P&L account. Can I leave the narration? Would that be okay with you?
Yes.
Can you leave that in exam though? No. That you need to write. Okay. This over. After this, you get 4 entries for your buyback. First, you have to cancel what? Equity shares you're buying back. So equity share capital you need to cancel. It has credit balance. To cancel, we will debit. So we will write equity share capital account debit. So how many equity shares we have in our question? 2,50,000 equity shares. Entire equity shares are you buying back or only 20%? 20%. So that means if you do this 2,50,000 got 25%, that will be 50,000. 50,000 shares you are buying back. Okay. Since share capital is shown at face value, cancellation also will happen at face value, which is 10 rupees only. So that means it is 5 lakh. 5 lakh to express in 1,000, it will become 500. But are you paying 10 rupees towards buyback, or what is your buyback price? Buyback price is 50. So the extra element or the premium element you're paying per share is 40. So which we call it as premium on buyback account debit. That is, yeah, you can directly write what, or you can write the same thing. So 2,50,000 into 20%, that will give you a number of shares multiplied by the extra element, which is 40 per share. So that means this is what, 20 lakh. So this piece becomes 2,000. Okay, to what? To equity share buyback, or simply you can write to share buyback account. To equity share buyback, that is 2,500. This premium is a loss. Loss gets transferred to P&L. But before that, check. As per section 55, premium on buyback can be set off with securities premium. Do we have any securities premium? Yes, we have 2,200 or 22 lakhs. The premium is only 20 lakhs. Can you set off entire premium with the SP? Security premium? Yes. So what is the journal entry? Premium you have debited, that you need to transfer.
Premium on buyback account debited to security.
Or ulta na? Security premium account debit. Security premium account debit 2,000 to premium on buyback account 2,000. Two entries over. Whenever you buy back, you need to create one reserve known as CRR to fill what? Capital gap. Now you need to stop what you're doing and listen to me for a minute. So you bought back equity shares. Should I have to consider premium for CRR purpose? Your capital is always shown at face value. How much face value of the share capital got reduced? 5 lakh or 500? Okay, so that means there is a gap at this point of time to the extent of how much? 500. Did you issue any shares now? No. Did you issue any preference shares before? Yes. How many months before? 2 months. But more importantly, why did you issue that preference shares for? For the purpose of buyback. Is that okay? That means this preference shares. How much preference shares have you issued? 200. That also can be considered for CRR purpose because it is issued with what intention? The purpose of buyback itself. So here the gap in capital is 500. Yes, the actual equity share capital is reduced by 500. But since you gave additional preference shares, capital gap got filled to what extent? How much preference shares did you roll out? 200. So 200 ka gap is already filled up. How much gap is still remaining? 300. So that means for 300 or only for that 3 lakh you will create CR. Did you understand this? Once more or okay? Online also. Once more, okay. So equity share capital you have debited here, no sir? Because you cancelled equity share capital by how much? 500. So your capital has reduced by how much? 500. So your capital gap is how much? 500. No matter what, that gap has to get filled. 2 ways to fill: either issue new shares or create CR. Have you issued any new preference shares? Yes. Right now you would have not issued, but you have issued how many months back? 2 months back. With what intention? For the purpose of buyback itself. That means when you issue preference shares, your capital has increased by how much? Initially, your capital has decreased by, because of buyback, it has reduced by 500. When you issued preference shares, your capital increased by 200. So how much is gap still remaining in capital? 300. For that, you create CR. That's all. Okay. All right. So now the creation of CRR amount is clear. So from what will you create CRR? Either you can use revenue reserve or P&L. So the entry is revenue reserve balance will reduce. So the entry will be revenue reserve account debit to CRR account, or we write the full form only better, to capital redemption reserve. So that is 500 minus 200 was the preference shares, no? Yeah. 500 minus 200. So you will create CRR only to the extent of 300. Narration is being CRR created. That's all. One last entry towards buyback. That is the payment. So payment entry is when you pay, the equity share buyback will get nullified. Right now it has a credit balance. So that means the journal entry will write is equity share buyback account debited to bank account. How much you need to pay totally towards the shareholder? 500 towards face value, 2000 towards premium. So totally you need to pay 2500. That is your entry. All the entries are over. They've also asked the balance sheet. Let's do one balance sheet for extra practice here. Anyone copying anything? If you're copying, I'll wait. Else, if you're through, I'll also proceed.
Question they didn't mention purpose. They should share for 2 months. They didn't mention any purpose.
Here, check.
No, if they didn't mention.
If they didn't mention, okay, what do you think they would have mentioned? Let's listen to your things fully. What they've said. They just said preference shares, huh?
Issued 2 months back.
2 months back. No, if it is issued for the purpose of buyback, it will be considered. Otherwise, okay, take that as a call. Like that, they will not give it. That will become way too ambiguous. Some students will make an assumption that it will issued for the purpose of buyback. Some students will assume it is not related to buyback. So you'll get two sort of answers that will create ambiguity. Such ambiguous question will not give you in the question. Either they'll give you a clarity on this, or absolutely no clarity will be given. They'll only give preference shares. All this line only they'll cut off. Okay. Otherwise they'll give proper. I see I will not do so much of this thing also. Okay. They will give enough information. Okay. So I think we'll proceed with our balance sheet. Balance sheet here they prepared. Huh? Okay. But still one we'll prepare. No problem. Later we'll see. Balance sheet of which company is this? D. Okay. Balance sheet of D Limited. You did a buyback, no? So you can write after buyback or post buyback, something like that. You can write after buyback. Have they given the date? Any particular date? If they have not given, you can leave it blank. Give break, somebody is asking. Somebody wants break, it seems. We'll finish balance sheet intake. Okay, I got already tired. Okay. Particulars and what? We'll prepare note. Okay, somebody saying with notes this time. But in examination, ideally, you may not have time to prepare the notes. Bring it in. You know how to bring it in now, I think. Both the ways, I think you're comfortable. Yes. So maybe one with the note we'll do. Particulars, note and amount. So we'll have maybe these columns. Okay, what is the heading, sir? First, Roman letter 1. Equity and liabilities. Under equity and liabilities, point number 1. Shareholders funds. Under shareholders funds, point number A. Share capital. Since you said you want a note, we'll prepare note number 1 for share capital. Where since anyway doing note, let's also prepare note for reserves and surplus. Also, that is note number 2. First, we'll do all that note also parallelly and then come. So here we will write notes to accounts. That is particulars, amount. Again, all the amounts are in thousands. So always give a disclosure of that. All the numbers are in thousands. Okay, note number 1, we're preparing for share capital. First disclosure you need to give is how much is authorized capital. Check the question. Have they given any authorized capital specifically? So they have only given authorized, issued and subscribed capital. So I'll write in the same way. Authorized, subscribed and issued capital. All right, sir. Sir, initially I had how many equity shares? 250,000 shares. In that 20% I cancel. That means now I have only 80%, can I say? 250,000 gone. That means how much is remaining? We have a 2 lakh equity shares of, what is the face value? Of rupees 10 each. Of rupees 10 each, fully paid up. So that means your equity share capital will be 2 lakh into 10, that will be 20 lakh. I'm expressing everything in thousand, so that will become 2000. That is your authorized, subscribed, actually this is what, this is here you have both equity and preference, no? Okay. All right, no problem. So, okay, no issues since I've given the common heading, we'll write the same. So this is for equity share capital. We also have some preference shares. How many preference shares we have? We have 2000, 10% preference shares of rupees 100 each. So that means that is what, 2 lakhs, huh? 2 lakh will become 200. I did not do any drama for that. It's the same, right? Okay. That means what is the total equity share capital, sir? Or what is the total share capital? 22 lakh or 2000. This 2200 you have to show it in your main balance sheet as 2200. Like that. Preference shares is used, right? Now, where did we use? We did not use any preference shares. Preference shares is issued, that's all. So, preference shares is still there in your balance sheet. Since we have issued a preference share, CRR need not be created for this 200. You will create CRR only for the balance. Just because preference shares is issued does not mean it got utilized. Okay, so that's still there in your balance sheet only. Only for CRR you need not create. That's all. Balance sheet may still it will come. Okay, what is the next one? Note number 2 is for your reserves and surplus. So all the reserves one by one we'll list out. Check the question. What is the first reserve? Help me out. First we have capital reserve. How much value of capital reserve is given in the question? All these numbers you tell me please. 1000. So did we change any capital reserve or balance is still same? Same. Okay. After capital reserve, what is that? Revenue reserve. How much is the revenue reserve given in the question? 3000. Did you utilize revenue reserve for anything? Yes. Using revenue reserve only you created CR. So your revenue reserve you debited, meaning its balance has got reduced by 300. So that means its balance will not be 3000. From 3000 it will reduce by 300 and it will become 2700. Okay, after revenue reserve, securities premium. The balance given in the question is 2200. Okay. Did you utilize security premium to set off any loss? Yes, there was a premium on buyback 2000 which you set it off with securities premium. So your security premium balance will reduce by 2000. So its balance is only 200. After that they have given P&L, right? The balance of P&L given is 3500. Just check the journal entry, that's all. One, I think you had a loss on sale of investment. That if you want, you can pass. I think you can have passed entry for this. Or here only, instead of saying loss on debit, loss on sale debit, directly you can debit P&L only. That is also okay. Since I have not done that, here one more entry I can pass. That is P&L account debit to loss on sale. How much is that loss on sale? 800. Or in first entry only, instead of loss on sale, use directly debit P&L. That is okay. Okay, your investment, you have sold it at a loss of 800. So your P&L balance will reduce by 800. You had a premium on buyback, but did you adjust premium on buyback with P&L or securities premium? So that was not there. Did you create CRR from P&L or revenue reserve? Revenue reserve. That means P&L balance will reduce only by 800. So your this thing will be 2000. 2700 is your P&L. That's all. One more reserve. You created one CRR, one extra reserve. So CRR will come. This is a balance sheet note here given. Any account that has a balance goes to balance sheet. CRR, how much did you create for? You created CRR to the extent of 300. So that will come as well in your notes. So your total reserves in surplus, if you add up all this reserves, you're getting how much? 3700, 3900, 4200, 4900, 6900. Is it 6900? So total reserves in surplus is 6900. If you don't do all this drama, show all the information which I showed here only. That is okay. So how many marks will we allocate to balance sheet? Not much. Balance sheet normally carries about maybe 2 to 3 marks. That's it at best. Okay, depends on the adjustment. This, yeah. Here for all this adjustment for CRR creation, okay, for entries and all, marks will be awarded more. Maybe this and all. Normally these questions get asked for about 8 marker at the tops or maybe 10 marker. Around maybe 3 to 4 marks at the tops for balance sheet, I think. Depends also on the adjustments. This looks very simple. Maybe around 3 to 4, not more than that according to me. Okay, so this is the shareholders funds done. Say after that, what is it? It is non-current liabilities. Under non-current liabilities, we have long-term borrowings. Under long-term borrowings, I think, do we have any debentures given in the question? Not given. Oh, chumma we did, no? Should have told me 2 minutes before. Okay, so that means this is required. No. So that means what? We'll erase all. You need not write at all. Okay, leave it. In fact, examination, it's not there, no? So not required. Cut it off. So non-current liability not there. So directly we can take up what? Current liabilities. That is there. Huh? That is there. Okay. Okay. Trade payables. How much is the trade payable given in the question? 1400. Check the journal entry. Did you debit or credit trade payable anywhere? That means whatever balance originally it was, same balance will continue. So trade payable 1400. After that, what are they given? Anything else they've given? That's all. So that means I think you should be good with what? The total of your liability side. So that is how much? 10,500. So next we can start with Roman letter 2, that is for the assets. Under assets, point number 1, non-current assets. Under non-current assets, point number A, property, plant and equipment. Check, do we have multiple assets?
No, sir.
They have not even done note there in the, so that means PPE ka initial balance was how much? 9,300. Did you buy any extra property, plant and equipment of fixed asset? Did we sell? No. So that means the balance is still the same, which is 9,300. We also had a non-current investment for 30 lakh. That we have or we sold? If you want for your reference, you can write a non-current investment. Write nil because it is already sold. Examination may not required, only for your reference here. In your books, that's all. Okay, any other non-current assets we have? No. So that means next we can prepare current assets. Under current assets, what and all they have given? First, they have given inventory. Check your journal. Inventory given value is 500. Check your journal. Did we debit or credit inventory anywhere here?
No, sir.
No, that means the balance of inventory will be as it is, that is 500. After inventory, they have given trade receivables. Given value is 200. We did not use the trade receivables. So that means the balance will still be 200. Last component is cash and cash equivalents, meaning cash in hand, cash at bank, etc., etc. That we call it as cash and cash equivalents. The balance given is how much? 800. Cash balance will change because you sold some investment, you made payment to equity shareholders and all. So balance would have changed. Come back to the journal entry. You sold the investment for what price? 2,200. That means your bank balance will increase by 2,200. 800 given because you sold it, its balance will increase by 2,200. Did you make a debit or credit bank anywhere after that?
Yes, sir.
You made equity shareholder ka payment worth 2,500. So your bank balance will reduce by 2,500. So that means ultimate balance is 500 or 5,000 or 500. 500. So I think no more assets. So if you do the total, is it matching? 10,500 is the total on the asset side as well. Balance sheet is not that headache scenario. Just the journal entry. You need to be kind of do it properly. That's it. Notes to accounts you want me to show? Huh? Okay. All right. Somebody is looking for a break since a long time. So we'll take about 5 minutes break and we'll come back. Okay. Not much problems more. So 5 minutes break is sufficient. All right. See you in a bit.